$8 trillion just quietly disappeared from America's banks. No lines, no panic, no headlines. By the time this video's over, you'll understand exactly why that happened. And whether your own money is about to follow it out the door, this isn't a story about a crash. It's something stranger, a bank run that doesn't look like a bank run at all. No screaming, no emergency press conference, just millions of quiet, rational decisions happening at once. And some of the banks in the middle of this are a lot closer to you than you'd think. Here's a number that should genuinely annoy you. The average savings account at a regular community or regional bank pays around 0.61% a year, according to Bankrate's own weekly survey. Now here's the other number. A 4-week U.S. Treasury bill backed by the same government that backs your FDIC-insured deposit is paying around 3.62%. That's almost 6 times more interest for the same risk. Zero in both cases. Picture $10,000 just sitting there. In that average savings account, it earns you about $61 a year. In a 4-week Treasury bill, that same $10,000 earns you around $362. So if you found out you could get 6 times the return for the same safety, you'd move your money. That's exactly what tens of millions of Americans have quietly been doing. Here's the strange part. This money didn't vanish. It relocated. Money market funds, the unglamorous accounts that mostly hold short-term government debt, now hold close to $8 trillion. That figure comes straight from the Investment Company Institute, the industry's own tracker. And here's a detail that tells you a lot about how cautious this money actually is. Roughly 80% of that $8 trillion sits in what's called government money market funds, funds that hold nothing but treasuries and treasury-backed repo agreements. Only a small slice, around 15%, sits in riskier prime funds that also hold corporate debt. Translation: this isn't speculative money chasing a hot return, it's cautious money, leaving a 0.61% account for the closest thing to a risk-free 3.62%. To put the scale of this in perspective, at the height of its pandemic-era stimulus, the entire Federal Reserve balance sheet peaked at about $8.9 trillion back in 2022. Americans have quietly built something close to a shadow version of that just by tapping transfer on a banking app. And here's the detail almost nobody reports on. None of this made the evening news. But it's not just a curiosity. This shift is putting real pressure on a very specific group of banks, and that's where it starts to matter for you. Not every bank is losing this fight equally. The very biggest banks in the country have scale, wholesale funding markets, big institutional clients, other ways to replace deposits that walk out the door. The other roughly 4,300 FDIC-insured banks in America don't have that luxury. And here's the twist, that number used to be closer to 9,000 a couple of decades ago. The industry has already consolidated hard, which means the banks still standing are carrying a bigger share of this pressure with fewer competitors left to absorb it. Why does that matter, even if you've never opened an online savings account? Because these are the banks funding small businesses, farms, and local real estate. And according to Q, for 2024 regulatory data, 59 of the country's largest 158 banks already exceed the exposure level regulators treat as a red flag for commercial real estate risk. They're already stretched. They can't keep losing deposits and keep lending like normal at the same time. And here's the thing that should really make you sit up. This isn't even the first time this exact movie has played. Rewind to the 1970s. Back then, a regulation called Regulation Q capped how much interest banks were legally allowed to pay you on a savings account. Inflation was running hot, just like now, and a brand new product called a money market fund offered savers a way around that cap. Sound familiar? Depositors piled in, banks lost deposits by the billions. And for a while, it looked like traditional banking might genuinely lose that fight. It didn't. Banks adapted, regulations eventually changed, and the industry survived. Eventually, regulators phased those old interest rate caps out completely, and banks were finally allowed to compete on price like everyone else. The Federal Reserve's own researchers have studied this exact pattern and concluded that banks facing new competition typically don't just sit there, they adapt through new products, new regulation, and new strategy. The difference this time is the players have changed, but the core mechanic savers chasing yield the second they're legally allowed to, is exactly the same one that reshaped banking 50 years ago. Here's the twist most people are missing entirely. You'd think banks would just raise their rates to compete. But under new Fed Chair Kevin Warsh, the Federal Reserve has actually been leaning toward holding or even raising rates further, not cutting them. If that happens, the gap between Treasury bills and your local bank's rate doesn't shrink. It widens. A wider gap means more deposits leave, not fewer. The very mechanism designed to fight inflation might be quietly accelerating the exact bank drain we're talking about. And this isn't a theory. The Fed's own senior loan officer survey, the one where banks anonymously admit what they're actually doing, already shows tighter lending standards on business loans across companies of every size. In the most recent reading, banks are pulling back before the cameras show up. Now, if you've checked the stock market lately, you might be thinking none of this adds up. Regional bank stocks have actually had a good year. The KRE Regional Banking ETF is up around 28% over the past 12 months. So which is it? Are regional banks in trouble, or are they thriving? Here's the honest answer, both, just on different timelines. That rally is backward-looking. It's Wall Street rewarding banks for rate cuts that already happened in 2025, which lowered what banks pay depositors faster than their existing loans reset. That's a temporary tailwind, not proof the deposit flight problem went away. And remember that 59 of 158 stat from earlier? That's exactly the kind of risk a rate-driven rally doesn't fix. It's still sitting there, quietly, underneath the good headline. The real test is what happens from here. If the Fed hikes instead of cutting, that tailwind reverses right as the underlying deposit drain keeps grinding on underneath it. So what does that actually mean for you sitting there with a savings account? Banking, at its core, is simple. Deposits come in, loans go out, and the gap between the two is how a bank survives. When deposits leave, lending doesn't stop immediately. It just gets quieter, tighter. A small business owner gets told her credit line isn't renewing this quarter. A local developer can't refinance a bridge loan on his usual terms. A farmer's bank raises its collateral requirements before spring planting. None of that shows up as a headline about a bank run. It shows up months later as a layoff notice, a stalled project, or a sorry, rates went up phone call. The Fed's own survey data says this tightening has already begun. The rest is just time. So here's the one sentence to take away. This isn't a bank run driven by fear. It's a bank run driven by math. And math doesn't panic, it just quietly adds up until the number is $8 trillion. If this is the first time you've heard the phrase silent bank run, you're not behind. Most people genuinely have no idea this is happening because it was never designed to make headlines. If you want to see where this money goes next, including a new type of digital dollar banks are genuinely terrified of, that's exactly what we're covering next. So make sure you're subscribed before it drops.